I had a variety of different ways that I was thinking of potentially starting this video, but I think I have it figured out. I think I have it figured out. I will be talking about the end-to-end AI solution, the AI control tower, the great consolidator. We are a ubiquitous platform for the enterprise. Of course, if you didn't catch this joke, I'm trying to pretend to be the ServiceNow CEO, which is quite the character. Welcome back. My name is Arya, and usually I don't waste your time, but I can't promise that to you today. Ladies and gentlemen, software stocks are absolutely in the gutter, and actually we could put these down here. Software stocks are down across the board. I am honestly speechless in terms of just how badly these businesses are selling off. I mean, across the board, super high quality names, even, like ServiceNow and Shopify. I mean, you look across the board, these are best in class software names that are down upwards of 5%, 10% just on the day. And that's on top of, sell-offs that have occurred over the past year to date or the past couple months. Like these businesses, many of them are down 50% or more. Monday.com is about to go down to the double digits range. So across the board, software has just been getting killed. And so I kind of wanted to make this video because I've kind of boiled it down to three-ish different reasons as to the sell-off. And we'll kind of go through with it. Obviously, some of you are going to be looking at, but what are some of the buying opportunities here? How can we determine what software companies are actually getting disrupted versus what software companies have some sort of staying power and whatnot? And again, I'm going to answer all of that. I have boiled it down to a handful of different reasons. And what I'm personally going to be doing with my portfolio, by the way, as I kind of showed in the initial screenshot here, I'm down close to $6,000 on the day today. And this is all public knowledge. If you head over to Blossom, which there's a link for it in the description, it's completely free to join. You can see my live portfolio down to the millisecond in terms of what's actually happening with my portfolio, what trades I'm making, all that great stuff. It's all public. I am losing a ton of money. By the way, a decent amount of the money lost today isn't even software related. It's ASML and Amazon, which happen to be about 55% of my portfolio. So part of the sell-off today isn't even software related. I would kind of say, Zeta and Adobe are the two software stocks in my portfolio. I guess you could kind of group FICO in there as well. It's categorized as a software business, even though, 80% of the operating profits of the business actually come from credit scores and whatnot. But anyways, I have three different reasons and everything's timestamped below. So feel free to kind of skip around. First and foremost, this is the vibe coding sell-off, right? So with the whole movement in terms of vibe coding, where you essentially type a prompt into, say, Claude or Lovable or Base 44, any of these different vibe coding websites, that obviously makes the creation of software significantly easier. Now, right away, I kind of shoot down that sort of bear thesis in the sense that I actually worked at a software company. I used to work at Fiscal AI, and I kind of saw the internal workings of what it takes to actually sell software. Mind you, it's not just making the interface. Making the interface is probably historically has been the easy part of running a software business. There's a whole customer service aspect to it. There's a whole sales team that you have to have behind this. You consistently have to update and kind of maintain the software. There's bugs that you need to fix, so on and so forth. It's not as simple as just spinning up a UI, spinning up a website, and call it a day. So this whole notion of there's going to be increased competition from faster time to develop software, yes, that's true, but that wasn't what made software companies special to begin with. It's the whole sales team and the ecosystem and the customer service and the consistent iterations of developing this software over time that has made these software companies special. So right away, the whole argument of there's going to be an increased amount of competition, there's always been immense amount of competition in the software space. The reason why Salesforce used to be a 300 billion market cap company, the reason why it's doing, 40, $50 billion of revenue is not because they were able to just spin up a UI and spin up a software interface and call it a day. They are the industry standard of customer relationship management software. Same thing goes for an Adobe. Same thing goes for an Autodesk. Same thing for a ServiceNow. Same thing for any of these massive software companies. The reason why they are as big as they are is because of the ecosystem and the inner workings and everything behind the scenes that has made them so massive. The constant iterations of the software and being able to adapt to what their customers are looking for, right? So that's not what made software special. The whole notion of vibe coding competition, that I kind of shoot that one right away. Item number two, which makes a little bit more sense and I think will impact some software companies, is okay, now that you can vibe code these softwares, that would mean that if you're Pepsi or if you're Nike, if you're a customer of these software companies, you can now make that internally, allocate a couple different developers to it, and you no longer need a CRM software. Again, that one kind of falls short a little bit. I think some softwares will be impacted by that. For example, I think one of the clearest examples of a business that can potentially be impacted by this would be something like Monday.com. Now, if I were to take a guess, I think Monday.com survives, and I think there'll be a business that will end up being around and continue to grow their revenues and so on and so forth. But if there was a company to be disrupted in the new paradigm, it would be something like a Monday.com, which has very small switching costs. It's task management software at the end of the day. And at the same time, it's pretty easy to kind of replicate it in-house. You got to imagine again, like a Fortune 500 business, they don't necessarily need to pay a third-party vendor such as a Monday.com. Instead, they could vibe code something, not vibe code per se, but like they can make this sort of software internally much easier and not have to rely on a third-party vendor. And in terms of, the maintenance and constant update and so on and so forth, the costs for that are also relatively low for something like this. Again, it's not as mission critical as say something like a CRM software. On the flip side, I think the super mission critical softwares, which we can define in a second here, those companies will probably end up being fine. You got to imagine something like, again, a Disney, a Nike, Uber, all these different massive Fortune 500 companies that are paying for a CRM, that are paying for an Adobe, that are paying for a ServiceNow. Those are super mission critical softwares that their sales teams and their employees are using on a daily basis. They have probably put, in some cases, decades of customer data within these different softwares. The switching costs alone are immense. No matter if that new website is vibe coded or not, if there is going to be a CRM competitor that is 10 times cheaper. It doesn't matter how it was created, but it's 10 times cheaper and it works better. There's still immense switching costs, whether it would be quite literally physically moving the data from your CRM over to a new CRM, time relearning costs, right? So that's something we got to consider as well. If you are using Salesforce in your day-to-day job, all your sales employees and your customer service employees and so on and so forth are used to the user interface. Those are serious material switching costs to move onto a new system, regardless of whether that new system is AI native, vibe coded, whatever the case is, right? The example I kind of like to give with this is imagine like you are in the Apple ecosystem, you're used to the iPhone user interface and the iPhone iOS ecosystem and so on and so forth. You have a laptop, you have an iPad, you have the AirPods, right? Like you're integrated into the ecosystem. What are the switching costs of you moving everything off of the Apple ecosystem? Pretty immense switching costs, right? Like even down to like if you have your music stored inside of the iTunes or the Apple Music app, right? Like physically moving that away to like a Spotify, it's a difficult task. That's how I would kind of describe it to those of you who, maybe are not using these softwares or are not too familiar with it. There are serious material switching costs when it comes to moving away from the Apple ecosystem to any other ecosystem. And that's why Apple's ecosystem is so sticky and it's such a wide moat business. Same applies to the super mission critical software companies, whether it's a Salesforce, Adobe, ServiceNow, etc. Autodesk, another great example, Intuit even, right? So I think you will definitely have a lot of companies that are able to make some of these softwares internally, but it's going to be the low hanging fruit. It's not going to be a Salesforce. They're not going to remake a CRM and consistently iterate and update it and maintain it. There's a saying out there that Jeff Bezos says, focus on what makes your beer taste better. For these massive companies, Pepsi, Nike, Disney, etc. These massive companies, they're going to focus on what makes their beer taste better. For Disney, that's making better movies, focusing on Disney Plus and making that a better value proposition for their customers, as opposed to vibe coding a CRM software to save a couple bucks and potentially risk huge data migration costs, time relearning costs that would actually cost company revenues because your employees are less efficient at working. So overall, if I were to quickly summarize, item number one, in terms of there's going to be increased competition, there's always been competition. It's irrelevant that there is going to be new competition. That's not what made these software companies special. Point number two, these companies that are the customers of these software companies will be making the softwares internally. That is partially true. Again, I would say it's probably more applicable to the low-hanging fruit, the less mission-critical softwares. If your entire business is ran on Shopify, odds are you're not going to be switching off of Shopify just because there's an AI native vibe coded version of that website all of a sudden that you're going to be switching to. There is material switching costs to move away from these super mission critical software vendors. There's a great divide between mission critical and not that mission critical software providers. The companies that fall into the bucket of not that mission critical, those are the ones that should be having a greater question mark around their future prospects. Again, I hate to pick on the company because I actually do like the business, but I think Monday.com on a spectrum falls closer to the not that mission critical software business. And then at last, and I think the argument that has the most amount of merit to possibly leading to the sell-off is, even if these companies survive, even if the competition doesn't matter, even if their customers don't switch off, which is likely what's going to happen with the majority of the software businesses, in the age of AI, there will be AI integrated features that these companies need to adapt to. For the most part, if we take the example of Adobe, which I think is probably the clearest for everybody watching and listening, if all of a sudden you need to pivot a significant portion of your business over to a consumption-based or usage-based model of charging your customers, that will likely have lower margins than what you've historically charged just on a subscription basis. So for example, if Adobe is going to pivot their business to have image generation included in a variety of different features, right? It's not just going to be like a sort of how Nano Banana runs it today, where you just type a prompt in and then it generates an image. Odds are you're going to be able to use the generative fill feature. So for example, with Adobe Photoshop, you have like a little prompt box, whatever the case is, you're like, paint a swirly nighty sky, right? And then you like circle the sky, or like you click on it and then it adds a sky in the background, right? Or like, for example, you're like, okay, put a big water droplet on this image, whatever the case is, right? When you do this, Adobe charges you a couple AI credits to be able to add those features to the image, whether it's like add a goat at the top of this mountain, whatever the case is, right? So most of these software companies will be pivoting, not pivoting per se, but will be adding these sort of usage-based AI features into their softwares. We've already seen it, whether it's a Shopify, ServiceNow, I believe, has something, CRM with their Agentforce. I would assume, broadly speaking, all these different companies they already have, but over the next couple of years especially, they will be adding a lot more AI integrated features into their current workflow. So when you add these AI integrated features and you're charging for these credits, there's a question mark in terms of what that will do to margins. Odds are the margins on something like this is not going to be 90%. You're going to have to be sharing that with a AI model company. And so the economics of it are a question mark. And then by extension to that, if in the previous paradigm you have 100 employees and you're charging 100 subscriptions for those employees, in the future, if each individual employee is a little bit more efficient, do you still need the same 100 employees to do the work? If you're Pepsi and you need 100 people to do a marketing campaign, to make different posters and make different advertisements and whatnot, can you make the same marketing advertisement with just 50 employees that are way more efficient now? So in that paradigm, does that mean that you need 50 less Adobe licenses, right? So there's a question, we call this seat dilution. There's a question of seat dilution. Do you need the same amount of licenses and the same amount of subscriptions to be able to do the same amount of work? That remains up in the air. And I think that is the argument that has the most amount of merit, and we're just going to have to wait and see. I'm personally of the belief that there's going to be a content boom. There's going to be a content explosion. This is what the management of Adobe also outlines. Broadly speaking, across all of software, you're probably going to see increased efficiency. And these software companies will likely be able to charge for that increased efficiency. If each of your employees using the Salesforce software or using the Adobe software is now twice as efficient, odds are you could probably be charging twice more in terms of what you're charging for that software subscription. Again, remains to be seen, and the economics of this get a little bit muddy, especially with the consumption-based version of charging for these software features. But nonetheless, something to consider. That's another question mark over the software space, broadly speaking. In terms of what I'm doing personally with my portfolio, I would like to be buying every single dip that's possible. I'm particularly eyeing adding more to Adobe. I wouldn't be surprised if this company continues to sell off beyond this point. Currently, the stock price is about $270 per share. At the moment, I don't have cash, so that's what is kind of holding me back in terms of adding more to my Adobe position. I'm also eyeing a position in ServiceNow. I think that's a phenomenal business that's super undervalued. If we take a look at their valuation, I think they're trading at like 7 times forward EV to sales, which is just absolutely ridiculous for a 99 or 98% customer renewal rate. Super mission critical business. And yet it's only trading at 7 times sales. This business regularly trades at like 12 times sales, 15 times sales, depending on what, time frame you kind of look at it. So these are really cheap valuations for software. I wouldn't be surprised if the sell-off continues. I've also been a big fan of Shopify for a number of years. Now, this one trades a little bit more rich than all the other businesses because it's a little bit more insulated, given that it has that sort of e-commerce orientation. But nonetheless, this one was not spared in the sell-off either. Very recently, this business was trading at $180 a share. I think it's down about 33%, thereabouts. For some stupid reason, FICO has been getting sold off in this sell-off as well. The reason for that, of course, is that if you look at the sector that it operates in, or the sector that it's classified as a software company. But again, this company is not generating their profit, not generating the majority of their profits from software. They do have a software segment, which accounts for about 50%, actually less. It accounts for about 35% of their revenues come from the software segment. 60% of revenues come from scores. But then if you look at it on an operating income basis, I think about 82% of their operating income comes from the score segment. So this is barely even a software business, right? And the scores is what's growing 30%. Their software business is growing like 2%. Yeah, literally 2%, right? The software business is not what is making this a compelling investment. Not even close, right? So I'm definitely eyeing adding more to my FICO position. I'm definitely eyeing a ServiceNow position, Shopify position. I'm definitely eyeing adding more to my Adobe position. At the moment, I don't have cash. So, I mean, if you wanted to help out the channel, I would absolutely love if you just click the Blossom link. And again, you're able to see my live portfolio when you do make an account over on Blossom, see my live portfolio moves. Once I get a little bit of cash into the brokerage, I'll definitely be sure to be buying these software companies, which in my opinion are trading at bargain valuations. Can they go lower? Absolutely. Absolutely. The market can continue to go lower, can continue to trade at these irrational valuations over what is, in my opinion, pretty overstated fears. Again, like if we go back to kind of my main thesis with software broadly, is there's the mission critical bucket, which should be pretty well insulated, and then you have the non-mission critical bucket. These ones are a little bit more risky. Broadly speaking, companies like ServiceNow, Shopify, Adobe, Salesforce, Autodesk, I could go on and on. These companies will generally be pretty well insulated and will be able to adapt. For the most part, they are high retention software businesses, and it's not like they're not innovating, right? Like they all have these AI native, AI integrated features. The seat dilution question mark is probably going to be a bigger overhang long term for them, and they'll kind of have to be able to prove that the economics of that will work out for them in the new paradigm. With that being said, thank you very much for watching. Let me know what you're buying. If you are buying, if you're avoiding software at all costs, whatever the case is, leave me comments. I'm always happy to kind of read your comments down below. Other than that, thank you for watching and have a good day.